comes down to computers communicating.
The information superhighway can be a confusing mix of on-ramps and off-ramps.
Bitcoin is worthless artificial gold.
Is it still rat poison?
Probably rat poison squared.
We need to get into the world of, okay, this is actually foundational technology.
What the Internet of Money does is it creates a single network which can do a microtransaction to a gigatransaction.
The Internet is going to be one of the major forces for reducing the role of government. The one thing that's missing, but that will soon be developed, is a reliable e-cash.
Hey everyone, hope you had a great weekend. We're back for another episode of Final Settlement on a great Monday with the price of Bitcoin over $125,000. I believe it hit its all-time high this morning. We have an awesome episode. I hope you make it through the full podcast covering everything from Galaxy One's new launch to Morgan Stanley letting advisors offer 2 to 4% allocations to their private clients. Talking a little bit more about venture themes and how in a future way it'll be the only logical thing for asset managers, allocators to benchmark against gold or Bitcoin, given the status of the dollar losing purchasing power by 50% in gold terms just this year. Hope you enjoy the podcast. We're going to be out in Dallas this week. We're going to host a few happy hours, private dinners. So if you're around the area or thinking about making the North American Blockchain Summit, please do. We'd love to meet. If you're looking for tickets to the conference, I think we might have a few extra. You can shoot us a note. We'd gladly set you up. All right. Hope you enjoy the podcast.
All righty, gentlemen. Welcome back to another episode of Final Settlement. Today is Monday, October 6th, 10:14 a.m. Eastern Time. Q4, boys. Officially into Q4. And we're breaking out. We're breaking out right now. Gold's at like 4K. Bitcoin is making all-time highs as we speak. I'll pull up the Onramp terminal right now. 124.9. It was just at 125.3 or so a few moments ago. But we are breaking out, boys. How are we doing?
Pretty crazy. I mean, I think this is I think it's crazy that they're both together and the sentiment shifting. I think this is kind of the discussion we had for the past few months on this would cause a like secular change if you had it in the market sentiment that they were just getting fleeced. Gold bugs and individuals have known this, and definitely Bitcoin investors for 15 years, but the rest of the world hasn't. And if that just becomes part of the narrative, you can click a button and get a form of digital gold. It's pretty interesting for demand side.
Yeah, absolutely. And I think over the past several weeks, we've talked about it a bit on this show, a lot on the last trade. But this notion of the debasement trade is now very much in the zeitgeist. There was some headlines from Morgan Stanley, which I can pull up, but other sort of incumbent TradFi players as well, talking about gold and Bitcoin in a light that historically they haven't. Historically, when you think about TradFi firms, they if they have exposure to something like gold, it's 2% sort of at most, sort of a disaster hedge in a portfolio. And that line of thinking is just fundamentally changing over the past really months, and as gold's been making this move. But what was once sort of a 2% allocation is now, anywhere from a 20 to a 25% allocation recommendation from a lot of these types of firms. And naturally, as people come to gold and understand the thesis around protecting themselves from debasement, the natural evolution is to understand Bitcoin as digital gold. And I think we're still early days of that leg of the trade, but this is something we've been watching and talking about for a while, is just looking at the performance of gold. Typically, Bitcoin catches up in somewhat of a lagged fashion, but moves harder and faster once it does start to move. And we might be seeing the first couple stages of that, right now over the weekend and into today, in terms of Bitcoin sort of catching up with what gold's been doing over the past few weeks. I mean, gold's up over 50% this year to date, and now I think Bitcoin is around 33% or so. So the two top performing asset classes globally, 1 and 2, pretty remarkable. And I think this is again, still early days of people waking up to this, but as you have the Morgan Stanleys of the world, the Goldmans of the world coming out and saying similar things, this is just going to continue to permeate.
Yeah, I mean, I think this is the solace you find in a trade like this, in an industry like this, that it's just technology. Money is just technology, and at the end of the day, you can't force technology back in a box in the same way you can't force gravity in a way you don't want it to. That it's not apples to apples, but we saw this play out with Blockbuster. We saw this play out with Netflix. And we're going to see this play out with the largest institutions in the world that were historically staunchly against this asset have to come around. It doesn't even necessarily matter because of, quote unquote, what the market sentiment or debasement. It's like really just a client demand. And if those clients' assets are going to leave, and the demand also comes from, the fact that the currency is being debased, but it's similar to what we see with Vanguard. So that's the beauty of this. The way this all goes is it doesn't matter if the institutions adopt it or not. Like, Morgan Stanley, $7 trillion in assets under management. If they want any chance of those assets to stay there and then honestly grow in dollar terms, because that's what these two assets are going to be some of the fastest horses in the next decade. Well, it makes complete sense to put them in. The kicker here, because I want to continue to try to bring this back to the business and opportunity side, is that I'm fairly confident that institutions like Morgan Stanley and Visa and Amex will be able to offer better products than the first versions of what we've seen in Bitcoin and digital assets, meaning because they have better distribution, better branding, better design. But I don't believe they will win the second version of anything digital assets Bitcoin related, meaning that world-class entrepreneurs that come at this space from a native perspective will run laps around these institutions on a long enough time horizon. And it has nothing to even do with they don't have the right people, because they don't have the right people. They leave to go start the other firms. But it's really because there's too much inertia in their existing $7 trillion in assets that they can't actually compete. It's Innovator's Dilemma 101. And that's really where the big opportunities are going to lie, is how do you lay sound assets next to stable coins, integrations, best-in-class financial services around counterparty risk. There's a huge opportunity there. And this will tie into some other announcements that came out just today, but I know Liam probably has some thoughts.
Yeah, 100%. It also is shifting the entire dynamic right now, because Morgan Stanley wouldn't say 2 to 4% in Bitcoin and gold unless Bitcoin's volatility had come down a little bit. It's not quite as volatile this entire cycle as it has been in the past. We can touch on everything BlackRock ETF related, but now that's top 20 ETFs in the world. The open interest on the ETF is bigger than everything on Deribit too. And so just the amount of hedge funds that just want to just make money straight off the volatility and any compression in spreads, that's going to continue to make this asset class less volatile, which relates directly back to the Morgan Stanleys of the world, because while they do get paid on AUM and of their clients, they also get fired if the drawdown is too large. And that's why you've seen many of these types of advisors be willing to put their clients into long-term government bonds that they know will go down over time and be negatively yielding in real terms. They're just more willing to open up the aperture to Bitcoin and gold relative to just these the long-term bonds. But yeah, as you mentioned, we'll touch on this a little bit later, but everything BlackRock related, like they've had extreme success getting out of the gates because everybody knows who they are. They're trusted right now. And, a lot of the Bitcoin native companies just aren't. But yeah, it's a good transition into the Galaxy One, because there's a lot to touch on there.
Yeah, we can move to launching Galaxy One. Maybe just before we do that though, because Michael, I think you bring up a good point around how businesses react to this quote unquote trade, and the recognition that hard assets are now more in vogue than probably they have been in 40 or 50 years. And what does that actually mean for a business, an incumbent? I mean, on one hand, it means you should probably be storing some of your balance sheet in either of these assets, gold or Bitcoin, but it also means you should be offering them to your clients. And so, we've seen some early signals of this, like with Cantor coming out with a gold Bitcoin product. I think there will be more of that, certainly. And I guess, Michael, the question to you is like, put a finer point on what you meant by like, the sort of V1 of these things may be won by the incumbents, but the V2 may look somewhat different and be won by more Bitcoin or crypto native firms. Like, what does the V1 look like, I guess, in your mind?
Yeah, so I guess like if you go back to anchor and contextualize, well, what is that even? How do you know, right? Like, what are you talking about? It's like, well, if you go back for 10 years, who were the first people that adopted digital assets? And it was none of them. They just had no view in it. They had no way they want to express it. And it was obviously coming, but they were behind the 8 ball. And naturally, as the price has ticked up and the demand has come, they've said, okay, well, we get somebody wants this. And well, again, the more sophisticated people like the Ray Dalios and others probably have larger percentages from risk 1% to 3%. Most of those advisors believe that's all it is. It's a risk asset. You're probably going to, cycle out or rebalance. And the point being is the V1s are going to be building exactly how the traditional market was built with, Omnibus is a great example. The insurance policies that manage it, not allowing delivery, maybe allowing delivery, but then having to figure that out, just like the rehypothecation collateral. And so that's really where you got to pinch yourself if you're listening to something like this and building, looking to invest is, well, it's just natural. If you're holding a material position in Bitcoin, doesn't matter if you're Love, Morgan Stanley, BlackRock, or Fidelity, and it grows to 10 to 25%, if not greater. Well, why in hell would you trust them in an Omnibus wallet to just leave it there? And it's not that you don't trust them. It's just that can you afford if something happens that you don't get that asset out? And so that's really where the multi-institution comes into play, and then lending against it as well. There's just going to be native properties that come across that. And then you can start to think about the big gap, I think, then if we're right, is that this notion that there's 21 million of these things, there's much less than that. And if that's going to be a base asset next to gold, then you're going to want the integrations and custody to be tightened into whether you are cross-collateralizing, lending against it, getting access to gold, dollars. That's not how the existing plumbing works. It's not how they even want it to work when you think about a traditional 60-40. And so it's just ripe for disruption. And to just make the last point is, to your point around like TradFi's whole game is, net interest margin, holding the asset, rehypothecation, the fact of like multi-institution as the easiest example for them to say, oh, hey, like we're not going to be able to have unilateral control, and everything that goes into it is just a very hard thing for people to swallow. Now, I believe over time they will, just how they had to adopt Bitcoin to put it in a 2 to 4% position. But that's the beauty of building right now and knowing these things. So hopefully that kind of outlined it a little bit better.
No, that was great. That was perfect. Liam, any other thoughts, or you guys want to move on to the Galaxy deal?
All set from me.
All right. Michael, I'm going to hand this one to you. Galaxy launches Galaxy One platform. I think Coinbase One is also a thing, so they could have done a little bit more creatively on the naming convention here. But what does this mean? What are the implications here?
It reminds me of the flicks where you like the scripts get leaked and there's like different shows that kind of like start resembling other shows. They probably like somebody was working on it, quote unquote, first, and the other one was like, we're going to get it out. So Galaxy One, they launch their platform. I think there's two aspects for me personally that were interesting. Galaxy just seems to really be executing at a very high level. They seem to really potentially being one of those firms that hits the intersection or convergence of TradFi and the digital asset space. Part of this launch had, premium yield accounts for high net worth investors, access to interesting products to start: gold, Solana, Bitcoin, and I think Ethereum. And it's effectively their first kind of product out into the retail market where they've traditionally been institutional players. So between that and then just their natural cycle into AI, they were holding a lot of bags when it came to power production. I think their stock's taken a huge boom to that, given that they're now AI, they're managing AI compute. The other thing goes back to probably most relevant here, and that we talked about just a second ago, was just the notion that we're going to see this cycle out of TradFi firms that are naturally going to have to start offering digital asset native services, and then the other side of it, and they're going to be doing it via building vertically integrated themselves or partnering with others. And then there's going to be the other side of that, which are digital native firms that are going to be integrating more TradFi products like this 8% APY. And I think about that a lot in the context of like what we're building at Onramp. And there's just the notion of people generally want to have a unified experience when they deal with their financial life. And so I don't think there's a one size fits all. It's just going to be an interesting model to see kind of where the winners end up on a long enough time horizon.
Yeah. I mean, what do you make of this yield product, though? I mean, generally, I've been conditioned to think skeptically about any sort of yield offering. This says high income investment note offering 8% APY, but only to accredited U.S. investors. The yield is powered by Galaxy's institutional lending business, and unlike the 4% cash account, it is not FDIC insured. So,
yeah,
not a ton of detail on how they're generating that 8%.
Well, there's a couple things. Like one is it's dollar yield, which at least gives me a little bit of less of a pause because it's dollars. So like, there's a lot of ways to get 8% yield in dollars. But also Galaxy's been around the block. They've managed lending markets where, have a good lens into their work that they're doing with Arch. And they're pretty conservative. So the point being is that, Arch, as an example, offers over collateralized loans. They get, anywhere between, they charge anywhere between, call it roughly 10 to 12% spread. Galaxy, invests in that, or partners gives them, call it 9, cost 9. They give 8 back. Just throwing out numbers. These aren't actually, but you see where I'm going with it is there's a lot of investors that naturally don't want long exposure to BTC. The other thing that's just a more meta point to 8% yield is I wonder how far, I'll throw this back to you guys, how far we are from just the notion of anybody passing any kind of dollar yield without denominating it in something else, whether it's gold or Bitcoin, persists or lasts for. Because I've been thinking more about this in the context of venture, and obviously we're Bitcoin denominated and we don't make money unless we return Bitcoin to investors. But if you think about today or a year ago, somebody raises a fund, and let's call it whatever the number is. It can be 10 million, it can be $100 million. Well, $100 million, how much Bitcoin does that buy you today? Is that 1,000, I think, BTC? Roughly, let's say it's at 100K. And so in just 10 years, conservatively, I think we'd all think it's $1 million BTC. Well, that's $1 billion, in US dollars you have to return in Bitcoin terms. You have to return that Bitcoin. But the real point is that what does the dollar look like? So the dollar, if it's already losing 50% of purchasing power to gold in 1 year, well, what does that look like in 10 years? And how are people, and the same thing could go for a micro example, which is on an 8% APY. Like that's effectively kind of inflation rate. So you're putting your capital at risk to the point I think, Brian, you're making. But it's like, why don't you just buy the Bitcoin?
Right.
And now obviously we're still early to that, but I don't think we're starting to get closer to this realization of like the risk, quote unquote, risk-free rate, if you can get custody right, ends up just being holding the underlying, which has been my whole reason why the DAT thing doesn't make any sense, because you're just putting all this capital at risk for execution risk versus just holding the underlying thing, but hold more of it because everyone's still under allocated.
Well, yeah, I mean, that's a really good point. And where my mind kind of goes is like, I don't think we're there yet, but I think as this continues to play out over the course of the next few years, I think there will be a recognition that like the 8% yield is not enough, right? And then that will cause, moving out the risk curve even further to offer even higher yields on these types of products or other mechanisms. And so that's what I would see occurring is like there will be a recognition that like if the debasement rate is 7 to 12%, then clipping your 8% yield on whatever product or service you're going through is just not going to be enough, and then that'll force other people to offer 12 or 15 or 20% yields. And we've seen like little sort of micro instances of that in more of the crypto specific world where, you have all these protocols where people do yield farming and you get 50% APYs. Like I think I expect some of that type of mentality and thinking to blend over into the TradFi world once people realize that, it's very difficult to compete with if everyone's offering, 5 to 8% yields. there will be a natural incentive for people to offer something that's a little bit higher risk and could offer an even larger yield. But that's just kind of where my mind goes with it in terms of how this could progress going forward.
Yeah, people don't know how to underwrite that, and that's where all this the kind of natural deleveraging comes from. I guess the second part to that, I'm curious, Liam, your thoughts on, for easy math, is like you raise 100 million and you deploy it, and you hit a 3x, so you get net return, call it 300, 400 million. Actually, net of fees, you're definitely way lower than that. But point being is, like, let's just say it's like at $1 billion or $1 million Bitcoin, that's 1,000 BTC, but that's actually like closer to 0.3 BTC your return. It's only like 300 of that Bitcoin. Is just like the math people are going to start to do on, like, why don't I just hold this underlying thing? I'm just curious how far you think we are from that.
Well, I think we're going to be pretty far from that for the majority of people, but it always happens at the edges. Like, just like Bitcoin was proliferated by just the individuals adopting it, those who adopt Bitcoin from their personal balance sheet are going to start thinking, okay, well, if I start a business, I want to get more Bitcoin with it, and that's why I'm going to make my internal hurdle rate actual Bitcoin, and then that will end up going out to other investors who are considering investing in venture versus just holding the Bitcoin themselves. It's just broken at more so the company level than anything else, which is why we go back to this 8% APY and many other people out there trying to gain a few basis points on their internal cost of capital, rather than understanding that the end goal is either more Bitcoin or gold, if that's what you prefer. But at the same time, there will be many different pension funds and long-term capital who are going to be extremely far away from that. And they're going to look at Galaxy's premium yielding 8% APY and think, hey, this is interesting. There's obviously some risk involved, but they can, make some arbitrage play on whatever, and they're going to think that they can pick up a few free dollars on the floor, while at the same time that they're just missing the fact that the entire trade is just how much Bitcoin can you really get on the other side of things. And the dollar is going to have so much more debasement between the next 10 years, and they're going to be kind of picking up pennies in front of a steamroller.
Well, how about this? So one is, what if they don't necessarily have to know? Because I know that's pretty hard for a lot of like individuals to be like, well, I'm trying to get more Bitcoin. That's the game. But it's, what if they're just trying to get more dollars, which they are, and they come to the conclusion that Bitcoin is just a proxy for net dollar expansion. And so the way I'm working into this is, because it's interesting, a lot of people will be like, well, there's no way you can return more Bitcoin. And like the funny joke is, well, you can't if you don't try. And what I mean, no, but seriously, because what I mean by that is, well, you can't actually return more Bitcoin if you have a venture firm in dollars, because inherently you've baked into it that you get money if you return dollars, not Bitcoin. And so it's like, well, on our side, we don't make anything unless we turn Bitcoin, right? So then you already put the incentive on the right track. And then you're basically putting your money where your mouth is. You're like, you get your money back and you're going to get some proxy of Bitcoin, which is going to be much more than the dollars. And so what I'm really getting at is, how far does it take for the market, if we believe this debasement trade is happening and people are going to wake up, and again, it starts at the edges, but it'll be individuals, start to demand from their GPs and other fund managers, you have to benchmark against gold or Bitcoin at some respect. And it's like, because those are proxies for dollar liquidity, and I need to make sure that I can't just go and buy those, because I could just go buy those outright, which is going to be beautiful, because that means there's going to be much less asset managers in the world. And there's also going to be a lot more efficient capital allocation, because the second that happens, you're just like, well, shit, I got to make more money back. Now, I know this is probably like, wishful thinking, and we probably have a long ways to go. But that's the beauty of like where we're at, is it's just rational, this stuff. We were talking about the gold Bitcoin thing for a few years now. It's coming to light. Like, this will happen because it's just a rational thing for an investor to do, is to demand more of the thing that gives them more purchasing power versus less. And then even if somebody says, well, I'll pay dollars, they can't return Bitcoin. It's like, well, just benchmark against Bitcoin and then return the dollar still, but don't get paid unless you outperform. And they'll be like, no, I can't do that.
This is a beautiful thing, because it's exactly how we talked about with essentially Morgan Stanley trying to adopt Bitcoin, but it's going to cannibalize all their existing businesses. So it's not going to be the super large incumbents who just recognize that the entire way that they benchmarked all of their funds was actually a flawed model, and having to explain that to a very large swath of investors that already have invested, and saying, hey, we actually did this wrong. And so naturally it will be the relatively, ones or twos at these bigger firms that try to get their firm to adopt it, because they know at the end of the road, like, every individual is going to want to demand these things, and they're going to, not demand it or not adopt it, because it will be an implicit admission that their entire business model is wrong. And so the people will naturally go out and start their own businesses themselves. And so that's essentially how this is all going to happen. It's going to be the and there will be LPs that demand it from their general partners too, but the partners have no incentive to admit that everything is flawed unless they're actually starting to lose capital. I think very few are going to admit it before they actually see the problem. It's kind of just like the entire debt situation that the US is in too.
This is the true Wild West in my mind. Like, if we had to go back, right? Like, the people staying in Europe and they're like, no, everything's fine. It's great. We'll like live under serfdom. And then there's people that are like, fuck it, I'm going to America. And then there were people like, fuck it, I'm going further west. There's no rules. Everybody is open to new things. And then we're going to like make it work. And some people died along the way, and some people had flawed models, but the ones that end up making it, there's a whole world on the other side of that. That's like effectively where we are today. And why I say that is because there's so many people now waking up with the quote unquote debasement trade, where all of this stuff was taboo. Now you can start to find your cohort, and we find them, they come in, we invested in them. They're our LPs of like, wait, this just makes rational sense. It's like, I've been investing, I've been saving money, and I know there's things out there that need to be built, but people aren't building them the right way. And it doesn't look right. It doesn't look right that people are going to hold these plastic devices spread across all over the world. It doesn't look right that like people are selling Lightning or other merchant fees, but nobody's spending. It's like people just need infrastructure. People need access to gold and Bitcoin. People need like these sound products. They need to be able to lend against it based on where we are today. So Wild West, buckle up.
Yeah. I mean, I would agree with Liam's take that like you're not going to see a full embrace of this from the TradFi folks, but what I would expect is like people to spin out, as you kind of alluded to. So like if this continues, right, and let's say Q1 next year, gold's at 4,500, Bitcoin's at 150 or 200, like I would expect to see some more boutique shops, not the big names, not the incumbents, but like boutique shops, spin outs that are denominating in either gold or Bitcoin. I do think we're not too far away from that.
Over under 12 months. I was just about to ask you that.
Under, I think under, because I think this is going to accelerate. The debasement trade will accelerate through the end of the year. And I think people will start waking up to not only that, but what I'm going to pull up now is this is the year-to-date performance of major hedge funds. They're all underperforming gold by like 50%. They're all underperforming Bitcoin. This Bridgewater, Pure Alpha. Yeah, go ahead.
So, sorry, one thing, just before we transition to this was the whole pitch around why we were like is in a great spot is the debasement trade, or if you're going to denominate your firm, specifically venture capital, in a harder money, isn't happening in a vacuum, meaning like the companies actually have to have unit economics. They have to do things. And so the point being is that not everyone can do it. It's like even if they could transition and spin out. So this is where a lot of the interesting angles will come from our set of like, if you just build a firm that has a proxy for higher discernment and efficient building in the new world where there's a cost of capital that's above, basically printing dollars, you're going to be in a very good position, independent of returning the BTC. You can hit, our benchmark to 1.25x. So if you hit 1.21, you're still going to outperform every other firm. And then all that liquidity is going to naturally come to you because you're going to be like, well, wait, you actually understood this. You knew who to hire, how to think about building in a world where there's no free capital. Is I think the last point on that, just like exciting part, as long as we can make our stuff work.
Yeah, 100%. I mean, if you just look at this and, let's say hypothetically, we didn't mark up any of our business in our portfolio. We returned 1x Bitcoin at the end of this year. We'd be outperforming all these top hedge funds. Like that is the moral of the story here, is that if you just hold a denominate in a harder form of money, one, it makes you more discerning, which is the real critical part. But two, you can outrun all of these fiat denominated people that are just playing the wrong game. There was a few other, Liam, I don't know if you had anything else on that, but there was...
No, I would just say it all goes back to the incentives, and you can talk about Sharpe ratios and Sortino ratios all day and how you're the best performing at all those metrics. But at the end of the day, what most people really just want is more dollars and more Bitcoin or more hard assets too. And that's why chasing these wrong metrics and being evaluated on all these wrong metrics is just going to drive worse outcomes. And being in a dollar denominated world is just inferior relative to living your personal life on a Bitcoin standard, as well as all of your investment decisions. And it could be gold standard too, but the world is kind of very, very slowly waking up to that.
And the last part on that is, don't let anybody convince you people can't return more gold or Bitcoin to you. It's like a very fiat take. One, because money's meant to be spent, but two, is we got so far away from delivering value as a society that people literally lack the imagination of how to deliver value that can make more money. And that's where the DAT craze again comes into play. It's a lot easier to financialize Bitcoin versus just provide goods and services that individuals need, and then to charge a nominal fee on it. Like that comes up a lot. It's like, well, how can you make more Bitcoin? It's like, well, you can provide value to the world, and then they pay you for it, and then you give it back to your investors. It's not like rocket science, but there's some version that people are like, we can't return more Bitcoin. It's like, yes, I can, I will, and I'll show you. It's a very like the world's gotten very crazy that is actually even something you have to discuss.
We're going to have to put some research out on this, because it's a great point. And when you think about the world in a state where we're eventually under a Bitcoin standard, there will be the value of your savings will actually just be a proxy for the productivity of people in society and the outcome of all businesses and people getting more efficient over time, which, they should. But if nobody actually does anything and they just say, okay, I'm going to sit on my Bitcoin all of my life and just sit at home and play video games or do whatever, the money will actually become less valuable over time, because there will be less production of goods and services into the real world. And so the value of your savings will actually go down rather than increase. If nobody actually goes out and produces anything, the net economic output will decline. And that's not to say that you have to go out and do it yourself, but it's just a framework to view the entire world under.
And what would be more valuable outside of time than Bitcoin in that world is your reputation. So that's how you get the money, and that's how you get, right now when you have dollars, their accountability doesn't exist. Think about how many founders started companies, whatever, started another one, left the VC firm, started another, underperformance. It's all just hidden on this haze of nominal versus real. That's actually, I know we want to probably transition, but that's been the most interesting thing is, for 2 years, we've been really talking about nominal versus real returns and how it's been masked. And that's what's come to light in this debasement trade, is people waking up to the notion of nominal versus real. And we need to come up with easier ways to understand it, because it's not that hard, but it just sounds so to the normal person, it's just the thing that lets you buy more goods and services versus the thing that doesn't. But anyway.
Right. Yeah, it's the concept of nominal sounds more confusing than it is, but it's just you're denominating the thing that's being debased, so it's not real. It's literally not real. I wanted to sort of jump back to a track that we were kind of on this before with the Galaxy One deal, and what we were talking about was both sort of crypto native firms and the incumbents sort of trying to bridge this gap. So another example of this, I would say, is this Binance announcement which you brought, Liam. Binance to offer turnkey crypto as a service solution for trad institutions looking to offer trading, custody, and compliance. So this sort of just reminded me of the Galaxy One deal and sort of the another example of the crypto native firm trying to bridge the other way into TradFi.
Hey everyone, hope you're enjoying the show. Just want to give a quick word from Onramp. If you're not familiar, we have an incredible new institutional line of products that have come out, including a fundamentals research series that Glenn Cameron, our head of institutional, has been working on. I'd highly suggest taking a look at it, sharing with, whether it's peers in the space, friends and family, as well as if you're an institutional allocator, taking a look. It's really foundational stuff about what gives Bitcoin value, total addressable market, how it works. Really great, content that meets the middle between institutional allocators and the type of research and polish they require, as well as the understandings from a Bitcoin, centric lens. This also applies to just net new holders that you've been trying to educate in the space. Onramp Trade offers the lowest fees in the industry. If we ever don't, please let us know. The main reason we can do that is because we offer other financial services outside of just, buying and selling Bitcoin, specifically our multi-institution custody offering. Would encourage clients to check out, or prospective clients. It's a great offering. You can find it on our website at onrampbitcoin.com. On to the rest of the show.
Yeah, Coinbase is doing the same thing, and it will probably, as a V1, be split kind of east versus west on who adopts these types of services. I do think I wonder what the economics of these types of deals look like for those institutions that are adopting like Binance or Coinbase's crypto as a service type business. But at the end of the day, it's going to, more than anything, these firms who haven't built it themselves should ultimately do these types of aspects, just because the data feedback from their clients is going to be really interesting, as well as getting a front row view of how Binance and Coinbase actually operate. It's not going to be perfect. Those firms we know are not, and we can discuss that a lot. But at the end of the day, they need to start understanding how these customers interact with the different products and services, what they really want and need. But for a V1, there needs to be, and there will be, a lot of adoption of these types of assets, just because it's going to take a lot of these legacy firms years in order to build it themselves, and they're going to have all these competing priorities internally of why this should actually take additional manpower and skills and capital away from their existing business, which is net making money. And everything from quarterly reports on how much revenue and free cash flow companies are bringing in versus actually going out and spending a ton of money in order to develop something new, which is uncertain how much market share they'll actually get. It's the incentive will probably just be pay a little bit more upfront, and rather than trying to develop it in house and have all this negative free cash flow for a long period of time, if you already have a sustainable business with operating and predictable free cash flows.
Yeah. I don't know, Brian, did you want to share, or do you want me to jump in?
No, you go ahead.
Yeah, I think that's right. I think this is an interesting model for intermediary, but between, and probably pragmatic versus build or buy, because I think Fidelity has been a good example of this, where they played a longer game and had to build a lot of that institutional inertia and knowledge on how to develop wallets and offer goods and services, and they're still probably very far behind something like Binance as far as like omnibus and a lot of the being able to receive and take it in kind. I think they just launched some of that after 10 years. I think it's right it makes more sense, like Binance doing this. We see there's a lot of opportunity when it comes to integrating with what we're building, whether it's holding a key, not holding a key. I think the big gap, and it's going to take a while, is just the notion that if Bitcoin credibly enforces 21 million, it more than likely is a reserve asset. And if that's true, you're incentivized to get your grubby little arms around as many Bitcoin as a business as you can. And that doesn't work if you're leveraging third-party white labels, and as well as, this is what I talk to banks about, is the disintermediation that has already existed with the top four in sub-custody. You're going to see more of that. Everyone's working on stablecoins right now and what's their plan there, but they're not thinking about how do they actually manage custody around Bitcoin. And it's not an either or thing. I think the folks that win, whether it's crypto, digital asset, and TradFi firms, are going to be the people that park best in class products around stablecoins, Bitcoin, even potentially gold. And then how do you let people cross collateralize and get access to dollars via lending solutions that are robust and resilient, and then kind of bypass a lot of this stuff? Because think about how much crazy stuff Binance does if you get their white label, and you have, because like there's a lot of complexity when you think about wallet architecture supporting 10,000 cryptocurrencies and everything under the sun. And that's just going to be the trend for the next, call it 1 to 4 years, as people are just going to get inundated with so much slog versus just like keeping the focus, especially empirically, whether it's market cap weighted to trading volume. It's all just Bitcoin and stablecoins. So you can just get, the meat without the fat, but nobody tells this story to them. So they just literally think it's like crazy. And they're like, well, you're just closed minded and you got to focus on everything. And it's like, okay, we'll see.
Yeah, it's a bit of a catch-22 in the sense of like, if you are the incumbent, the TradFi, or the fintech firm, I think you're right, Liam, in that it does make sense to do deals like this because there's sort of a, you're on the clock in some sense in terms of you need to be able to offer this stuff to your clients. And while the sort of medium to long-term right decision would maybe be to build it yourself and, think about it from first principles, there is sort of a race to market around this stuff, particularly for the TradFi folks and the fintechs, that, near term, it does make sense to just either acquire or do a partnership like this. So at least you have something. But to Michael, to your point, like that's probably not the right long-term path if you actually want to win longer term and get closest to the BTC and do things the right way and own your own infrastructure, et cetera. So it is a very interesting spot for those types of folks. And I did want to move to a couple other headlines related to this. And so we went from, the crypto incumbents bridging into TradFi. And so now we're going the other way, the, TradFi folks or, traditional fintechs moving the other way into crypto. So there was this headline: Walmart-backed fintech OnePay is bringing crypto to its banking app. And then there was another one that I think you brought, Michael, around Stripe, getting into stablecoins in a big way. So maybe I'll hand it to you, Mike, on this Stripe deal, but just more broadly, now going the other way from incumbent into crypto. Thoughts?
Yeah, I thought this was fascinating because effectively Stripe is going to want to let anybody, their clients, build their own stablecoin and pass or generate that yield, right? Because I think that's going to be something we'll talk about on this podcast, of just some of the market mechanics around Circle and Tether's dominance and how does that play out. But ultimately, I thought it was just very fascinating to see Stripe sit in the middle, referencing the acquisition of Bridge, and ultimately letting any kind of financial institution, fintech, or just traditional commerce business have their accounts, which they generally probably already do with Stripe, launch a stable coin. And TBD how that plays out for a number of reasons when it comes to interoperability. But I do think that it makes a lot of sense that if you have a lot of distribution, why you wouldn't want to own that wallet balance and then ultimately be able to incentivize passing that yield back to the client and generate more of the economics. So I thought that was a pretty interesting kind of nugget, and it ties into a little bit of the Binance stuff, but on the other side.
Yeah. Liam, any thoughts on this one?
No, it makes sense. I think we're going to see Tether and Circle probably be larger players for at least the near term. And then we're going to see a bunch of niche smaller players pop up with however much they have generally in terms of their existing deposits for their customers. I don't know how much additional distribution they're going to get outside of net new customers coming into the platform or their stablecoin, unless they have a really tailored strategy in particular. But this is a pretty easy way to just grab a couple additional bips if they're buying the treasuries themselves and just continuing to have their customers on the platform.
Yeah. And go ahead. Or I was going to pull up your other link from Standard Chartered talking about $1 trillion could exit emerging market bank deposits for stablecoins.
Yeah, so I think we've had a lot of numbers thrown out in the past, call it 6 months. Standard Chartered threw out $1 trillion exit emerging markets. I forgot who it was that had like $3 trillion by 2030. Funny enough,
what
today
Bessent said, right? Just in general, he was saying that would be the stablecoin market would grow from whatever it is, 300 billion to 3 trillion. Yeah.
And so we just, I think today's passed 300 billion in stable coins issued, or like, total value locked up in them. What I was thinking about going back to the OnePay deal, I'm curious because I think, Brian, you brought that, if you had any other thoughts there, is the notion of it's all going to end up looking like the same system again when you think about it, because like the stable coins probably get obfuscated away in the background. Like I think now when, again, I haven't thought deeply about it, but the initial thought is like the Tether stuff trying to raise that money is because their dominance has maybe peaked. And the notion of, if you're going to need this stuff to be interoperable, because if it doesn't, then you kind of like, unless you hit a flywheel of escape velocity, and I would make the case nobody has, because we're still so early. Like how many dollars are actually issued on chain versus still used? It's probably like 1% or whatever. Point being is that's going to get obfuscated, and they're going to need to be interoperable. So you're just going to naturally end up having people not really even knowing what they're using. And because this ties back to Walmart, I don't know the numbers, but it's just like their scale when it comes to, they're one of the few players that can actually get Visa and Amex and MasterCard to move when it comes to interchange, and being able to do just like lean on them when it comes to invoking, like if they want to make changes. And point being is that OnePay deal is kind of interesting, because if they own that fintech application and they have distribution via their people going to Walmart, and then they can get them to download that, well, eventually they would launch their stablecoin. But then over time, like if everything net settles to BTC and its interoperability at different layers, it probably looks, and there's all this interoperability at the stablecoin layer already. You can imagine like Satoshi start getting interoperable with stablecoins, and it all just like fuses together. And so anyway, I was just thinking out loud, like it's an interesting area we're going to, because it makes complete sense for everyone to launch their stablecoin because of it's literally a click of a button. It's digital, and there's not a lot of banking, not their infrastructure, but like the gatekeeping has been lifted. So now you don't need these large players like Tether and Circle to do it for you. But then if that is true, then the interoperability is gonna have to be there to make the consumer experience, where you don't know what's happening, which is ultimately just going to lead to nobody knowing what anything is, just moving up dollars again. Which means that a lot of these firms won't accrue a lot of value.
I think that's exactly right. Like what was interesting about this OnePay deal in particular was, and to be honest, like, I've never used the OnePay app, but I'm sure it has a good amount of market penetration if it's associated and majority owned by Walmart. So that's the sort of distribution angle. But what's really, I think you hit the nail on the head in terms of like, it doesn't matter what stable coins they're using, how they're using it. It's tightening the fidelity between your spending dollars and your saving in Bitcoin. So part of what this news article states is that they want to, probably won't happen until next year, but they offer the ability to hold Bitcoin and Ether in the mobile app, convert the crypto into cash, and use those funds to make store purchases. So this is kind of, we've talked about before, is just like getting the user interface and the user experience to the point where you don't really know you're using stable coins. There's this Bitcoin thing that sits right next to your dollars that basically gives you more dollars over time. So like you hold a certain amount of value in that bucket. It generates more dollars for you over time that you can use to spend on things. And so I think that's what stood out to me as interesting about this one, is like they've got the distribution, and now it's just about tightening that fidelity between dollars and savings. And I expect to see more of this. Like, Walmart and OnePay won't be the only people that are trying to get at exactly that use case and that interface to be super clean and really train consumers and clients to spend in dollars and save in Bitcoin. I think that's where this is all headed. And it's infrastructure and deals like this that will get us to that point.
Yeah, and that's going to be really interesting too, because a lot of, not a lot, but there are certainly Walmart customers out there who don't have access to bank accounts directly. And so being able to essentially store all of their finances into an app like this, it's not going to be all Walmart customers, but even a relatively small penetration of different customers who can do this will be great to see. And then Walmart is one who definitely should be exploring Bitcoin-based reward systems. They have such a massive loyal customer base, especially for Walmart One type customers, or Walmart Plus, I think it's called. And the just ability to allow your consumers to save in Bitcoin will just drive additional sales to your business moving forward, and be net good for you if all of your customers are actually saving their money in an asset that's going up over time, and going to allow you to have a little bit more pricing power too, as they just get a little bit richer over time.
I will say this is a little bit of a hot take, but I'm fairly confident that this proliferation of stable coins at the same time that we're at the current debt levels and then lowering of interest rates will effectively cause the next global financial crisis. And the main reason for calling that out is because I've been thinking about, well, you're naturally going to either want to net settle or put Bitcoin next to it to go into a harder form of money. But I also think it's going to matter for the self-preservation of the individual or the institution, because it goes back to like custody, where you think everything's fine until it's not. And so the ones that do it right will naturally be insulated, because their clients will have already parked the money in a form of, money that can't be debased. It's sitting, off chain, ideally, multi-institution, ideally, where assets, can't be moved or rehypothecated. But the point being is that the firms, when you start inserting more dollars, more risk goes out further on the curve. You're using it to back up derivatives. Like you're just going to, and then they can move at the speed of light versus what even bank wires had to do at Silicon Valley Bank. It's just going to add a level of volatility that nobody's prepared for. And it's going to be very interesting. But I don't see how it doesn't play out that way, given all the initial. It's less about stablecoins. It's more about the existing market. And then you just add basically gasoline to that. And that's how you end up with like a crisis.
Yeah, it's just going to be easier and easier to escape the perpetual debasement of money through either Bitcoin and stablecoins. Honestly, are less risky if you're just in Japan and you know that your money is going to be debased and you're going to have higher inflation rates, and they're going to continue to perpetually offer easy financial conditions. You're going to want a unit of account initially that goes down a little bit slower than actual Japanese yen, and that's going to be stable coins. And then you're going to realize that Bitcoin is right next to it everywhere, and that's actually going up in value versus just going down slower than the Japanese yen. And so the distribution of Bitcoin is going to kind of be turned on everywhere all at once, right next to these stablecoin assets too, as well as all the different cryptos. And there will be a lot of money lost, but ultimately it's going to really drive a lot of net new eyeballs onto the asset class as a whole.
Yeah, that's well said. Michael, you did allude to this notion of the duopoly in stablecoins, so Tether and Circle. Nick Carter wrote about this last week, effectively saying that that duopoly has topped. I think, forget the exact numbers here, but it was around 90% market share a year or two ago, and now it's down from there. So, any other takeaways from this write up from Nick, just on the sort of market share of stables?
Yeah, I think we kind of touched on this with the bridge deal, but it's just the notion that if Tether and Circle had the duopoly, they were taking the majority of net interest margin and taking it for themselves, not passing it through. What are they? They're in a situation, because ultimately that's how they're sustain their valuations and their moats. And you're going to have all these other competitors step in to allow you to launch them. And then they're incentivized because they can pass that through. I think there's another angle, which isn't really widely discussed, and it was part of that hyperliquid situation, is that let's call so Tether and Circle, let's call it, have 200 billion of the $300 billion market of stablecoins today. Well, that 200 billion sits on places like Bitfinex, owned by Tether, has some portion of it, and then Coinbase has some of Circle's. But the reality, there's all these other places that have that, and they're not receiving any of that yield. And so in a world where an exchange or another firm, financial service firm, wants to
issue its own stable coin, and then maybe they split the fees or the economics, and they give 2.5% back to the client, the holder, and then they keep the other 2.5%. There's just going to be a lot more competitive forces there, and that goes back to the valuation, kind of like top ticking and extracting it at the best point before this kind of plays out. I think is the essence of, and that's where this piece right here bringing up is yields are a race to the bottom.
Yeah, and with this chart here specifically is showing, this is pretty wild, stablecoin supply excluding Tether and USDC. So you can see really from the beginning of 24, you've seen this rise in sort of the everyone else bucket outside of those two major players.
Yeah, and the last part, like what Liam said about the Japanese yen and safe havens, they will be with the caveat, like they still are susceptible, forget about like being seized or turned off, that you don't know like where the risk lies when they start to, everything feels like it's going to get obfuscated and blended together on, if it's a corporate bond that it's going to or generating other yield, and then that corporate bond is insolvent and all these just different things. It's like, oh, sorry, your actual, because you decided to, opt into the 3%. This was in the terms of service or the T's and C's, and ultimately you kind of like have to take a haircut of 50%. Because like we had claims on it or whatever it is. I think that's the angle of people don't actually, they're still not your dollars. In the same way the bank's dollars are still not your dollars. And that's, I think, the thing that's going to play out on a long enough time horizon where people realize there's still counterparty risk outside of just the fact that they can be turned off or censored. Your account can just be wiped.
Yeah, exactly. It's going to be, there will be a ton of bank runs, and there will be lockup of funds, and you can only take out certain amounts over certain periods of time. And there will be a lot of rehypothecation in there, and your counterparty risk will also be important, especially if you're holding stable coins that are outside of the US too. I think that's going to be an even bigger issue as other currency or other nations just want their own debt to be monetized rather than just the US in general.
Hey, everybody. Hope you're enjoying the podcast. Just wanted to give a quick word from Onramp and the Knowledge Center specifically. I think there's a lot of individuals that have been listening to this podcast for a while. We hear from them every week when they finally decide maybe giving Onramp a try for some of their financial services when it relates to Bitcoin. We have a Knowledge Center that covers a lot of the commonly asked questions. You can always reach out to me. You can book a consultation to learn more. But common questions around what does our insurance by Lloyd's actually cover? What are the best IRA providers in multi-institution? Who holds the keys? Really, how does multi-institution custody protect against physical threats? You might be familiar with the launch of Onramp Guardian that was announced a few weeks ago. That adds additional layers on top of just the multi-institution security along with video verifications. As the price creeps higher, 125,000 all-time high will look small in the places that we're going. And so when you think about $175,000 Bitcoin, $250,000 Bitcoin, naturally, having built in this space for a very long time, most individuals are not prepared for that, whether it's a hardware device or, collaborative custody setup and understanding the XPubs, the wallet config file, how do they plan for inheritance, how do they access financial services, where, to make sure that the keys are secure, but they now need to access them to take out loans or sell Bitcoin. We solve for that and a bunch more. I'd encourage you to reach out. We'll be here when you're ready, but to the extent that this price uptick has been one of the reasons you kind of want to learn a little bit more, I'd gladly take the consultation. We have a full team that will also support. All right, on to the rest of the show. Hope you enjoy it. Yeah, I don't know if this is if you had anything, Brian, or this is a good transition to the car deal, because... Yeah.
I'll go there in a second, but just one more thought on this Stables report from Nick. I do think that this is a important closing thought in the sense that, and I'll just read some of this. I used to adamantly believe that we'd only need one or two major stablecoins. Network effects and liquidity are king. But do stablecoins actually benefit from network effects? So they're not the same kind of business as Meta or X or Uber. The blockchain is a network rather than the token. If you can swap in and out of the token frictionlessly and swap between blockchains quickly and cheaply, the network effects start to matter less. So I think this is actually the most critical point of everything that he's saying, is that as interoperability improves across these different blockchains, across these different stablecoin networks, as those exit costs trend to zero, there's really not a lot of lock-in across these things, particularly if someone's just using them in a trading format. They're going to be in and out of them pretty quickly anyway. They start to care less about what the actual stable is and just getting in and out of it quickly and cheaply. So I think this is a fundamental point of why perhaps this duopoly might not continue to exist. I think there's still a lot of fragmentation, but that is likely to improve going forward in terms of reducing those barriers. But you wanted to go to this cars deal. Some maybe obfuscated risk right now, generally in credit markets. I think this is what this is referring to, but I'll hand it to you.
Yeah, and I think the main reason why I reference this post that conversation around stablecoins and risk is if we understand, most people listening and that are long Bitcoin, that there's long debasement, long volatility, and as more monetary units get inserted, that just gets more, it distorts the signal around the capital allocation, which inherently means more businesses either get funded that lack fundamentals or propped up that should go away. And so it doesn't insulate that from being long Bitcoin or dollars, like stable coins, that as interest rates lower and more stable coins get issued, the capital still will get misallocated. And so this came to light. A firm called Tricolor shows same cars tied to thousands of loans. And some of the key points or initial review of Tricolor Holdings shows that at least 29,000 loans pledged to creditors were tied to vehicles already securing other debts. Roughly 40% of the 70,000 active Tricolor loans contain attributes identical to those of at least one other loan. It's the point that this exists everywhere in the financial system. It's very easy and people are incentivized to do this. It's similar with subprime, where you're making your money on generating and offering up dollars from a banking or financial service business. And so you're incentivized to not do the due diligence. You're incentivized to look the other way, and everyone's incentivized to take out more debt. And it just brings, again, just this notion of that, fiat economics don't work on a long enough scale. And so there's risk lying everywhere. And I think that's the thing that most people discount when they go into stocks, bonds, and don't see Bitcoin as a true store of value and gold and Bitcoin as savings, is they're just discounting the risk that lies within the traditional fiat system as, I don't know how to express that. Like, we'll need to do more on it, but it's the ultimate point is like the 60-40 in your capital is not risk-free. And so if you think Bitcoin's risky, you should probably do a little bit more work, because this lives within the whole financial system globally.
Yeah, this is this headline in particular comes on the heels of what I would consider sort of related headlines in terms of what we covered a few weeks ago around a lot of private credit funds that are offloading basically some bad credit, repackaging them and selling them off to insurers. Klarna's buy now pay later deal with, I forget the specific insurer that they sold a bunch of those loans to. So you start to see this across different areas of the market, right? Where credit risk in particular, is being obfuscated and hidden and disguised and repackaged. And it's not too dissimilar than anything we saw in 2008, but it's all sort of coming to a head again. And so this is just another example of that. And then there was this tweet, which this now has a community note on it, so I'm not exactly sure how accurate this is, but the report was that 40% of Coca-Cola's revenue comes from food stamps. Is this accurate, Michael? Do we know?
Yeah, I believe so. I mean, I think the community note was actually giving more data around the revenues and profits. Okay. But ultimately, whether it's exactly 40%, it's the core notion that Coca-Cola's stock and their free cash flows took a huge hit with the recent Maha announcement and the ability for SNAP benefits to go to sugary, beverages and other things. And it's this idea, again, going back to tie this back to business building, is whether it's investing in businesses or looking at it from, if you're managing your personal portfolio or an asset manager, it's like, well, what businesses actually don't even have sustainable unit economics because they've been propped up by a system. That goes back to, there's no shortage of these different businesses that exist that inherently shouldn't, but because of the amount of liquidity in the system, they justify it. And again, we've talked about this multiple times, whether it was like 21 and lower interest rates, or even go back to the WeWork examples. there's no shortage year after year, cycle after cycle, where the counterparty risk exists. And something like Coca-Cola, obviously a foundational business to America, but there's a lot of valuation that's crept into there that's been embedded by the government subsidies. We obviously know Tesla is another example of this. And I just thought it was more interesting because these things don't happen in a vacuum. I think we just want to look at stuff and be like, oh, that was just a one-off, like the credit loans and then this Coca-Cola subsidies. But these are just the most acute, kind of like loudest exaggerations that are easy to point to, but they inherently are everywhere because that's the incentive model of when money costs nothing but a button to click to create.
Yeah. So I just realized this tweet was actually from December 22, so I'm not exactly sure how it got resurfaced, but it was kind of going viral over the past week or so. But Liam, did you have any other thoughts on that? There was some AI stuff I wanted to get to, but before we do that.
One last thing, I think the reason why it got resurfaced was because they're spitting out free cash flows, basically like either went negative or took a huge hit, and people were going back to that it had to do with a large part of it with the subsidies.
Yeah, it was negative free cash flows. And I mean, we don't need to touch on this too much, but the snaps benefits will ultimately be issued from an AI through stablecoins. The New York is actually piloting that now of offering stimmies of 1,000 to 1,200 in USDC. And, UBI already exists just in the form of unemployment benefits, but it's only going to ramp up from here as there's more that we talk about of asset holders and especially people that own gold and Bitcoin, and Elon Musk hitting $500 million in his total net worth, or 500 billion. And there are many people out there who actually have zero or negative amount of personal wealth. So it's only going to ramp up. There are going to be more distortions in actually how people have capital and where what signals your business is getting in terms of, is this a sustainable business? Is this not? It's everything from, the 0% interest rates that Tricolor was getting back in the COVID time and allowed them to issue more loans on top of that, to additional stimmies that are coming either from SNAP benefits or just to the lowest end of the population. And so it's just going to be more and more distortion of the cost of capital and real business unit economics.
This is wild. I had not seen this.
No strings attached, 10,000 to 12,000 issued in terms of USDC in New York City for a couple thousand people.
Well, I just think, I think the USDC aspect, because I'm sure we sent money to a lot of people, but the putting it into the market and understanding, I think we all knew this is the direction it goes, but to see them already trying it out in USDC, and USDC, obviously the logical course is pretty wild.
Yeah, there's a couple interesting notes in here towards the end of the article. Still, stablecoins like USDC don't always live up to their name. Serious market shocks can cause coins to lose their peg and become worth less than $1. And then it says, there's also a question of how easily recipients will be able to spend the funds. Stablecoin use is not exactly ubiquitous. Some retail stores like Home Depot or Chipotle take USDC. I didn't even know that. But they're not a common method of paying rent or, for example, tuition. So yeah, that is kind of wild that they are piloting this. But I guess it's pretty small in scope, at least initially.
Yeah, but on the other side of it, I think Trump was saying there were something about passing $2,000 back,
right, the rebate.
To somebody.
Yeah, that rebate headline was pretty wild. $1,000 to $2,000, tax rebate. They're going to fund it through tariff revenue. That's if you take the upper end of that, $2,000 for every taxpayer is about 165 million taxpayers. It's like $330 billion of stimmies. So it's not nothing. That is a lot of debasement headed our way. So continue to take note of the debasement trade. As some might call it, it's the last trade. But let's move on slightly here. There was some AI headlines I wanted to get to, mainly this one. So OpenAI is taking a stake in AMD, chip manufacturer. And so you could take this a few different ways, but it's somewhat of a diversification away from reliance on NVIDIA for OpenAI. But the larger point to me or takeaway was something we've mentioned on the show over the past couple months, and seems to be a prevailing narrative is like this sort of like interdealings and almost incestuous AI economy that has sort of emerged over the past 6 to 12 months, where you have, this is now OpenAI taking a multi-year strategic partnership with AMD. They will commit to deploying 6 gigawatts of AMD GPUs. This will start in the second half of 26. And it'll be structured as a performance-based warrant granting OpenAI up to 160 AMD shares, which would be a 10% stake at 1 cent each, so vesting on certain specific milestones related to the deal. And so, like I said before, it diversifies OpenAI's chip supply beyond NVIDIA, elevates AMD's market position. So, yeah, as the headline here shows, AMD's stock went up 35% this morning as a result of this. But it does, raise the broader concern of industry concentration and just general centralization around a lot of these AI companies and the chip makers, and sort of this back and forth circular economy that's going on. Because I think Microsoft, who's deeply intertwined with OpenAI, obviously is also a large client of AMD already. So there's just lots of these sort of circular nature of a lot of the deal making in the AI space over the past several years. And then maybe one other thing to reference in relation to this is just AI venture funding continues to surge throughout the third quarter. So global venture funding in the third quarter increased 38% to $97 billion, and about 46% of global venture funding for the third quarter went towards AI companies, with 29% of that solely in an Anthropic deal. So again, this speaks again to the concentration of broad funding, venture funding that is going specifically towards AI companies. Thoughts on any of this, gentlemen?
Yeah, it's when things are going good, everybody looks like a genius. The money continues to go around in a circle, and you literally can't be wrong in any of the different bets in the AI space just because everybody else wants to get in. And as long as you're not the last sucker at the table, you're going to make out like a bandit in dollar terms. But it's just the most fiat thing ever in terms of OpenAI, which is hemorrhaging cash, getting stake in other companies. It's just sending all of the wrong market signals of nobody actually being able to deliver real value and free cash flow. But it's just everybody chasing this idea that at one point, if there is enough scale, then the unit economics and costs can come down without actually really focusing on if that will ever happen, and will the money be cheap enough in order to actually continue spending like drunken sailors until there is that breaking point in which costs of compute and the models do actually come down enough. And it's just more so a bet on, it's the same thing as the debasement trade, but just a worse version of it, just because there are so many different layers of counterparty risk and signals here that are distorting the market. It's just it makes a lot of sense when you understand that all of the fiat space is just chasing the same exact deals in the same markets and hoping that there will be another deal to come in and actually see this. I don't necessarily know this deal quite as much as some of the other ones out there, but they're all in the same exact space, which is I don't know when some of these companies go public or they actually get positive free cash flows, but it's just sad to see.
Yeah, I think there's a negative incentive, like what you referenced on the venture side and certain aspects of the AI boom, specifically like when you think about a net new incumbent or net new person coming into YC and launching an AI company, and they're going to get funding from it. It's where the market's, the distorted signal. Not to say there's not value there, but at that level, in the same way VC funds can raise more capital, they can tell their LP base, they can get the markups. With all that said, I don't think they're playing for the dollar returns in the sense that, or exactly, we talked about it like last week or the week before. I think there's a notion of just the amount of energy that's going to be required, among other things, that are going to be this massive inflationary spike and it'll be almost like public utility
you could see this coming from different angles of this stuff becoming systemic. And I think that's the race, is to become so large at scale and systemic that you're obfuscate, or you're not prone to the laws of gravity or like unit economics, in the sense that if you get to a certain size, whether the government's going to own a portion of these or you're trading dollars that we know are basically somewhat worthless, they can make more of them, into energy, IP, equity, the GPUs, the real estate, you're just getting as much of it. You're incentivized because you know that you're going to be made whole in some capacity. And the real like value, if you look at like Bitcoin as a value for moving into the digital world, is the value is to own the equity in that business and all of the underlying technology from compute and everything I just said. Because in that future world where we get to, you're going to be too big to fail. And so I think that's where you see all this like capital being deployed. And like you came out a couple of weeks ago with Sundar, and it was like similar sentiment between Sundar from Google, Zuckerberg, a few others, where it's like, we'd rather go to zero than like lose this race. And that's kind of like a different way of saying we're not worried about the money and the ROI. It'll be there as long as we can be one of the winners in this like new category. So I don't think they're trying to hit this like notion of profitability and unit economics. It's more of like, it's just get to that scale, and then they're going to be too big to fail. And I don't know exactly how it plays out or what their mind frame is, but I think like it's on the margins that's there. The rest of people are just chasing the wrong underlying unit economics incentives. But I think some of these bigger players like OpenAI, they know it doesn't make sense, but it's free dollars. They keep getting a raise from sovereigns and others to go and deploy. And then they're going to own those data centers. They're going to own all that infrastructure. And then when they don't have the right numbers, the government's going to be like, oh, here's some capital, stay afloat. And now the real value is owning all the wallet share, client relationship, AI models, everything outside of it, independent of the dollars. And I think they caught on to this probably pretty early.
Yeah, I think that's right. It's not about dollars. It's not about unit economics. It's this very somewhat unique technological state where there's the ability to say like there is this end goal that's so great that it'll allow us to outcompete all our competitors, have the sort of beachhead that you're referencing, and that opportunity is so great that it doesn't matter. The numbers don't matter. We're going to throw as much capital as possible. We're going to do as many raises as possible, because that opportunity, that goal is so great that it doesn't matter in the near term. It doesn't matter what our unit economics are, what we're burning, and so it's. I would say that's a flawed line of thinking, though. Like that, like it's. Like
it isn't. Well, here's the angle. They're basically, this isn't apples to apples, but they're like what DATs wish they could be. Because, no, seriously, think about it. Like, so a DAT is trying to access the capital markets to take dollars, buy Bitcoin, raise their enterprise value, and then effectively be able to leverage that. This is a story they say, and then they will make more Bitcoin and they will have that. Well, we all know it's BS. We've talked about it for long enough. But when you look at these businesses, they're doing the same market mechanics of taking cheap dollars to go and buy infrastructure that can actually be inflated away, like the whether it's the IP potentially, but then the physical assets, they own that. And you can make the case in that world where things get repriced, their valuation will still be greater than Bitcoin if they would have just bought the Bitcoin today, because there's only going to be, Bitcoin's finite, but also accessing the computing that they need. I'm not saying this is right, but it's a trade on, in that future world, people in Bitcoin terms, they will actually be okay because they're delivering some product of good and utility, and the market will have to be forced to price it if they need that kind of goods and services. Now, TBD if other businesses come out and they're better, blah, blah. But you see what I'm saying with it? It's like a similar trade. It's like, well, we're just going to take as many dollars, we're going to go to it in this new world, whatever the world's underlying unit gets priced in, we're still going to be very valuable. And we're actually using the free debt markets and capital to go and buy that with zero cost to us. And that's where I think that it actually kind of makes sense.
Yeah, I mean, I see that. I see that angle. Like, what is the alternative to doing this? I think you are more likely, you have a higher probability of losing if you don't take this mentality effectively, because there's also some game theory associated with it where like if everybody's throwing as much money as possible at it, then like you kind of have to keep up to even have a chance of achieving the goal or coming out the other side on top. So yeah, it's very interesting. Liam, any other thoughts? I know we're a bit over time here, so we can wrap soon, but any final words?
I just well, Liam, you were thinking. I just wanted to. So we got definitely I think all-time high. Well, I guess the all-time high was 343. That was like Saturday night, or I don't know if that was.
No, it was like an hour ago.
Oh yeah, that was an hour ago. But this chart I wanted to pull up because it's something that doesn't widely get shared. But it's just like, how can you, as anybody on the planet Earth, look at Bitcoin profitable days and not just like be interested? Because it just generally comes up from everybody, whether it's an institutional allocator or individuals, like past performance isn't indicative of future performance or whatever. It's like, well, it kind of is, like what would cause it to go the other way? I don't know. Yeah, profitable days is always one of my favorite.
It's all reflexive. It strengthens the actual network and people who want to participate in the network. There are only 21 million. There's going to be stronger amount of hash that are securing the network, and so it's going to only drive more network participants. It's looking pretty good for Bitcoin.
Exciting times.
Not for dollars.
Not for dollars.
Call out this week. We'll be in Dallas. So for anybody that's around, a lot of exciting things we have in the coming weeks. Big announcements on companies we've invested in. We're going to host a happy hour with Tetra Trust on Thursday night in Dallas. So if anybody's around, wants to reach out, meet up, come to the event, just shoot us a note. We'd love to see you.
Good stuff. All right. Thanks, gentlemen. See you next week.
Guys.
Thanks, guys.
Hey guys, I hope you enjoyed the show. If you liked it, please give it a like and a share or subscription. Like I mentioned, we'll be out in Dallas. The team from Early Riders and Onramp will be hosting a few events. If you're curious on what Early Riders have been up to, you can go to earlyriders.com, see some of the portfolio companies we haven't publicly announced yet. There's some very exciting announcements that are coming in the next few weeks when it comes to, looking at from the first treasury company, Bitcoin treasury company, business in the space that we backed, when it looks at the quote unquote debasement trade that's now being talked about today, back to company playing in the gold and Bitcoin space, all the way to new firms building globally on multi-institution custody. There's a lot of exciting things, including the stables with the accelerator that we launched. And then we have new teammates joining across the world, from investment banking to traditional portfolio management. We are really building a very exciting platform that should be pioneering what asset management on a Bitcoin standard looks like. If you're interested in getting involved, I'd encourage you to reach out, or you can shoot me an email, michael@earlyriders.com. All right. Hope you guys have a great week. We'll have an awesome podcast this week, and see you next Monday.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.